Good afternoon, everyone, and thank you for joining for our very interesting chat. And today we have Konrad Rolik, who started his career as a partner at McKinsey and BlackRock before becoming a regional CEO of Allianz, mainly focusing on Africa. And he is now a CEO and co-founder of Carbon Pool, which is an innovative carbon credit insurance solution. And congratulations on your recent fundraising. Like, I have seen some of the most exceptional results, 12 million and in the seed round. I think it's an exceptional that this kind of solutions attract so much attention. And when Konrad is not focusing on addressing climate change, he makes his own wine. Thank you for being with us today.
Thank you. Yeah, the wine is the hobby, and it's the sort of opposite side to what I do in business. It's a certain way to make a loss every single year as an amateur. Anyway, that's my wine learning.
Yeah. So please share a bit more about what Carbon Pool does and what kind of solution it is.
So Carbon Pool is a full-stack insurance company. We are in the process of getting a license in Switzerland. It's almost done. And there's a similar license to a Swiss Re or to a Zurich, except we use carbon as kind of our balance sheet unit, which is quite difficult and has taken us 3 years to convince the Swiss regulator FINMA on how to do all of that. So that's really what Carbon Pool is about, and we can talk a bit more about it as we go through the conversation.
Thank you for sharing. And recent events, especially, I guess, Los Angeles wildfires, made us all realize that it's not how big the problem is, that despite, some of the celebrities with $1 million houses were burned within a matter of a couple of hours. And then we saw some floods in Spain and other regions, which also had a massive impact, and there was significant losses. So I would like us to realize and iterate how big the problem is.
Yeah, the climate problem is obviously gigantic, and you saw in the presentations, especially the introductory plenaries yesterday, the fact that these things always turn up at the top of the list on 1, 2, 3, 4, or sometimes 2, sometimes 3. It is a massive risk. I was first exposed to this in 2005 when, together with Swiss Re, we were involved in setting up the Caribbean Catastrophe Risk Insurance Facility. And that involved applying all of the sort of Swiss Re, at that time state-of-the-art, but probably still quite good, cat models across the Caribbean states to sort of see, well, what's the exposure and the delta impact from climate on the insurability of these island states. And already in 2005, we had individual island states, and I distinctly remember Jamaica as being the first one which was essentially uninsurable. And uninsurable basically means that the insurance premium you need to pay per year is essentially larger. It's no longer affordable. It's larger than GDP growth. So these are countries where even after all of the adaptation that you can do, the insurance premium to cover yourself against catastrophe, and in particular climate catastrophes, is larger than your GDP growth. And you see that sort of happening everywhere. Florida, most private capacity has withdrawn from Florida. California, I was with State Commissioner Lara last fall. All the capacity already before the fires was being withdrawn from the Californian market. These are all areas that are essentially becoming uninsurable, especially from a property perspective. The LA fires, we had modeled up sort of propagation of wildfires into urban areas at the end of last year, and we picked out LA as one of the sort of 1 in 20-year risks, and then 3 years later it was burning. 3 weeks later it was burning. So it was sort of, wow, 1 in 20 can mean next month. It is actually all really, really rather big. Just as a sort of size of what this problem really means, that sort of hit me, the amount of excess CO2 in the atmosphere right now is about 1,000 billion tons. trillion tons. And the social cost that economists sort of attribute to a ton of CO2 in the atmosphere is about $1,000 right now. So that's a sort of cumulative cost to society, which means that's basically 1,000 trillion that we have borrowed from the atmosphere to sort of fund our life today. And contrast that to financial debt. It's about 3 times financial debt. So the amount we've borrowed from our own planet is about 3 times the amount we've borrowed from our future. It is a really staggeringly large number. And we're going to have lots of these, unfortunately, lots of these LAs and other really dramatic catastrophes.
And it's not, it was also made me to realize it's not that the catastrophe will not come, or it will not, like, it's kind of probable it will come. And we know that the question is how do I get prepared for next disaster? How do I get prepared for that? And then my question is, as an insurance industry, what can we do about it?
I think we can do.
What shall we prioritize our focus on?
This is obviously very difficult. I think as an insurance industry, we have been woefully absent from these conversations, to be honest. We actually have extraordinary insight into the damage that climate can do, and we do a very poor job at shaping policy around that. I think there's 3 things we can do. We can obviously use our balance sheets to drive that change. There's many problems with that, and that's the first topic, and we can talk through that. The second one is there is a protection gap. People are withdrawing from areas, and that's just going to increase. And so how do you close that protection gap? It is actually getting worse. Swiss Re published numbers on that, and you can see it's getting worse. And the last step, which is what we're doing in Carbon Pool, is really that de-risking of net zero. I mean, if I pick that very first one, just the invest in the transition piece. So in Europe, we've got about 8 trillion euros of assets on the insurance company's balance sheets. Globally, 30 trillion or something like that. The amount of that is invested in the green economy at the moment is like 3 or 4%, according to EIOPA. It's a very small number. There is a reason that is a really small number. And the reason that's a really small number is, as an insurance company, you have to you have to follow the rules and the regulations, and you have a risk-based capital regime. And so you have to assume that if the people sitting here in investment teams in insurance companies, they are optimizing, they are doing the best job they can, which means they're trying to get the best return with the least capital charge, and therefore make the insurance affordable. If you are trying to just sort of tell people, invest in green stuff, but that is now riskier or lower returning, then if you don't change the rules, the insurance companies won't do that. And right now we are stuck in a paradigm where, on the one hand, you've got kind of popular talk saying you got to invest in green things. On the other hand, you've got a regulatory framework that is unchanged since Solvency II.
There is an intention-action gap.
There is an intention-action gap. And as an insurance industry, I don't think we are doing very much around sort of having our voice heard there. I mean, having worked at all these big insurance groups, we try to avoid discussions with regulators. And here, actually, we need to get much more proactive and get ahead of the cart here. And get much more involved in shaping those discussions. Banks are much stronger there than we are in the insurance industry.
Thank you for sharing that, and I agree with it. And I think the change is coming, and we can see that, and more people are paying more attention to green investments. But I agree with you that it's a bit more riskier, and it takes longer time to return. And we should understand that like the average return on climate possibly will not be within 5 to 7 years, but will be within 10 to 12 or possibly 15 years. And we should be okay with that kind of time frames.
Yeah.
Now, you mentioned briefly about scaling back.
Yeah.
Understanding that there is a risk, let's say, of wildfire in California, and there is still people living there, and they cannot get a mortgage if it's not insured.
Yeah.
So how to build back in this kind of areas, and how we can address the protection gap in uninsurable areas?
So I think that you touch on the 2 points. One is the build back better. I think that's an obvious thing, and most insurance companies, I think, are actually proactively doing that already or trying that. I think that the real challenge of closing the protection gap and uninsurability isn't so much build back better. It's the fact that these areas are today uninsurable, and as a client, you don't understand the trade-off between adapting and investing to adapt and the lower risk cost that you have. And the reason you don't understand that is that we structure everything as a 12-month policy. And so there's almost no way that adapting and making yourself more resilient will pay back in a reduction of your 12-month insurance premium. When I speak to big brokers, the Marsh teams in particular, they are crying out for longer-term property policies to bring that certainty. And as an industry, we are basically not responding to that. We are not doing multi-year contracts. We are not giving the certainty to clients over an extended period of time. And as a consequence, and we know, especially with the global politics right now, uncertainty creates a very difficult environment to make those investment choices. So policyholders cannot see the trade-off right now between investing in adaptation and lower risk costs. And so they just don't do it. And so we're actually compounding that uninsurability problem ourselves by sticking to that 12-month period of risk. And that 12-month period of risk is, again, back to our own regulations. It's what we were computationally able to do when we designed the risk-based capital regimes. But there's no reason right now why we couldn't do a 5-year policy. But we just don't do it.
We just need to think differently, right?
We absolutely need to think differently. So, and the other point on that is, on the balance sheet, and I think Evan Greenberg from Ace and Chubb makes that point very strongly every single time, which is we have a regulatory regime where we are always looking in the mirror. So we can put on our balance sheet only what we can justify to regulators based on our models, and our models are all history-based. But here, we're no longer in it's not even a straight line. It's some kind of weird function right now where the climate damage is accelerating, and we are not able to put extra reserves on our balance sheet to sort of manage that. And without an ability to change those rules, without changing those rules, it's going to be very difficult to close the affordability gap.
You mentioned regulator, and I want to just open up a little bit. We all are here from insurance industry. I'm relatively new, but we understand that insurance industry has its own business models, its own vocabulary, its own regulatory requirements. So we kind of all understand that. Now, what Konrad, what you did was actually stepping into the complete unknown world. Like, imagine you are an insurance expert with 20 years of experience stepping in and saying, tomorrow I become an architect, or I become a ballerina or something. Like, it's completely new world, the climate, carbon market, and it has its own regulation, voluntary market and everything. It has its own vocabulary. You need to be a scientist to some of these models. You need to be, there is so much nuances into this. So, and also in your case, what you did was actually obtaining or almost obtaining a license. My question is, how did you educate the insurance regulator on the climate metrics and that it's actually important? And how was your journey on educating them?
I think we started with the use case. I mean, Carbon Pool started with a plain vanilla use case, which was somebody who was planting a forest asked me to insure told me no insurance company will insure my forest. And I said, that's rubbish. I'm sure I can get your forest insured. And he said, you don't understand it, Konrad. I would like the payout not to be cash. Cash is useless for me. Cash doesn't undo climate change. If my forest burns down, I want you to give me an equal number of CO2 removed from the atmosphere to compensate for that CO2 that's gone into the atmosphere. And these are carbon credits. And that is something that is wholly illiquid. You can't just you can buy 10,000 of them if you want, but you certainly can't buy $10 million of it, which is not a huge number, right? And so there's complete illiquidity in this space. And then I called up my different regulatory friends and I said, I'm trying to set up an insurance company with this very fuzzy carbon unit as my balance sheet unit. Would you regulate me? And the Bermuda team and the Swiss FINMA team both said, well, this is very interesting, let's look at it. But that journey has taken us almost 3 years now of literally monthly workshops with them. They have hired some people themselves. We've done this, extremely collaboratively, in contrast to the sort of relationship I had with regulators when I was sitting at a large incumbent. Here we've gone down an extremely collaborative path where we have they have been heavily involved. It's our idea, our risk models, our capital model, our proposals, but they've been involved very closely in the development of those things, and in the ultimate approval that we received in February.
Congratulations on that, and I'm sure they also understand the importance of these solutions, and that's the difficulty of being on the front line. That's the difficulty of being first.
Yes.
You have to educate the entire ecosystem, regulatory, the partners, the providers on the importance of it, but also the metrics. I agree with you. In climate world, everything is measured in CO2 tons, and there is a regulatory for that.
Yeah.
Now, as an insurance industry, to conclude, how can we contribute to net zero? How can we take a part in this? And there is also I think there is also a wonderful business opportunity in this new world. So how can we contribute to that?
So this is what we're trying to do at Carbon Point. I've had a couple of conversations with some of you bilaterals as well. I think one of the challenges we all have when we have this sort of sustainability discussions within our large incumbents, it's always around, well, we can't invest in that, and we're not allowed to underwrite those things anymore, and we're not allowed to do that anymore. So it's lots of no-no-nos. And that's not a very exciting kind of growth agenda. Net zero, the currency of net zero is carbon. It is a very noisy thing. You can have unintended emissions. All airlines need to do CORSIA credits for their international flights right now. So when the volcano in Iceland explodes and the planes now have to fly, an extra hour or two around over the North Pole to get between the US and Europe, that is an unintended emission. They didn't want to fly the longer route. That is a very insurable thing, but we can insure that in these CORSIA credits. They don't care for cash. Cash is completely useless for them. The penalties are horrendous. So cash doesn't help. What they want is these CORSIA credits. We can insure those CORSIA credits. That's a little bit the model that we've built in Carbon Pool, which is how do you put all of these carbon units, whether they're compliance credits, or emissions rights like ETS and CORSIA credits, or voluntary carbon credits on your balance sheet and take those risks. Unintended emissions, shortfalls in projects, they all create very noisy net zero paths. And the role of insurers is to make that path a smooth line. So that at least for the short term, 1, 2, 3, 4, 5 years, whoever you're insuring has comfort that they're going to follow a particular net zero trajectory. They have to do the effort, they have to do the projects. You can't insure somebody if they're not doing something, but if they're doing something, you can insure what they're doing. And that's the role that we play. That's kind of the climate opportunity here.
Okay, thank you for sharing. Yeah. And then actually I also wanted to suggest, it's not that there is a people and it's all of us should rethink how we move, how we drive, how we also eat. So there is there's many books, but there is one which in particularly interesting and captures all of these matters in terms of problem as well as business opportunity, called Speed and Scale. If anyone would like to read a bit more about how to address the climate change and to take opportunity on hand, right? But also what I believe that is with each and every one of us is to have this kind of mission to leave a better world to the future generation. And we should start with a person in the mirror. And each of us can contribute at our own little or big ways towards net zero. So thank you very much for sharing your insights, and thank you all for being here. You've been a wonderful audience today. Thank you, and enjoy the rest of the conference. Thank you.